Today, we're diving into a fascinating paradox surrounding one of China's major automakers, Great Wall Motor. On the surface, the company is posting record sales figures, but if you look at its market value, it's telling a completely different story. We're going to dissect these conflicting signals to really understand what's driving this divergence. So let's start with the good news. In the third quarter, Great Wall Motor delivered some seriously impressive top-line growth. We're talking about revenue surging more than 20% year over year. Taken by itself, a number like that suggests a company in robust health, with really strong demand for its products. But, and this is a big but, over that exact same period, the company's stock went in the complete opposite direction. It actually fell by over 11%. And right there, that's the core conflict. Record-breaking sales on one side and a significant erosion of shareholder value on the other. So this brings us to the central question of our analysis today. Why is the market penalizing the company's incredible sales performance? It's time to peel back the layers and look at the underlying factors that are causing this disconnect. Here's how we're going to break it all down. We'll start with those two conflicting metrics. Then we'll dig into the cost of their big transformation, look at the geopolitical headwinds they're facing, weigh their core strengths against market doubts, and finally, map out what the road ahead looks like. All right, let's get right into it. The heart of the issue here is that classic tug-of-war between top-line growth and bottom-line profitability. And the data really lays it all out. You can see third quarter revenue soared to over 500 billion Chinese yuan, which is fantastic. But at the same time, net profit just plummeted by more than 31%. So what does this tell us? Well, they're selling a lot more cars, but they're making a lot less money on each one. And this is the crucial point. The market is signaling that it's no longer impressed by sheer sales volume alone. Investors are looking past those big headline numbers, and they're focusing on the deteriorating quality of that growth. The conversation has completely shifted from a simple growth story to a much more cautious, show-me-the-money assessment of their path to profit recovery. So what's causing this profit decline? Well, it's not some accident or misstep. It's actually the result of deliberate, high-stakes investments. A huge strategic bet the company is making to secure its future in the new era of electric vehicles. Now, a DuPont analysis is a great tool for this because it lets us isolate exactly where the problem is. It breaks down returns into three key parts: profitability, efficiency, and leverage. And look at this. Their operational efficiency and financial leverage are actually pretty stable. The real culprit, the primary driver of lower returns, is that significant squeeze on the net profit margin. A huge driver of this margin pressure is the company's massive pivot to a direct-to-consumer, or DTC, sales model. Think about it. They're building out their own retail network from scratch. That means huge upfront investments in real estate, staff, logistics, the whole shebang. Now, you might be wondering, why on earth would they do this if it's so expensive right now? Well, the long-term strategic logic is actually pretty clear. First, it gives them total control over their brand image and pricing, which is absolutely critical for their premium models. Second, they get direct access to customer data, which is gold for future product development. And third, if it works, they could see much higher margins down the road by cutting out the middleman. The other big area where they're spending heavily is technology, specifically their proprietary High-4 system. You can think of this as the technological backbone of their whole off-road plus new energy strategy. It's designed to be their key competitive advantage in a very crowded market. Okay, so as if all that internal spending wasn't enough pressure, there is a major external threat emerging, and it's aimed squarely at one of the company's most important engines for growth. See, overseas markets have become absolutely critical to Great Wall's strategy. In 2023, they made up more than a quarter of all sales. And here's the key part. These export markets have been a source of not just growth, but also much higher profit margins compared to the hyper-competitive domestic market in China. And this is the direct threat to that entire global strategy. The European Union has just imposed new tariffs on Chinese electric vehicles. For Great Wall Motor, that means a new 21% tariff gets slapped on top of the existing 10% duty. You do the math. That's a total tariff of 31%. This policy puts them in a real bind in Europe, which was a key high-margin market. They're left with three really tough choices. 1, absorb the costs, which means sacrificing their already squeezed profit margins. 2, raise prices, which means sacrificing sales and market share. Or 3, undertake a massive, costly, and long-term project to move production inside the EU. None of those are great options. So let's synthesize all of this. We can boil it down to a balanced view, weighing the company's very real foundational strengths against the market's very real and pressing concerns. Okay, so the bull case, the argument for the company, is built on its competitive moat. It has a dominant position in high-margin SUVs and pickups, it has unique tech with its high-force system, and it has strong brand equity. But the bear case, the prevailing market doubts, centers on three questions. Will all this heavy spending actually generate a good return? Is the global strategy even viable anymore with rising protectionism? And is their brand portfolio just too broad and fragmented to compete effectively? Given this complex picture, what should we be watching to see which way this story is going to go? Well, there are several critical signposts to keep an eye on. There are 4 key metrics that are going to tell us a lot. First, profitability. We need to watch those gross and net profit margin trends to see if they can stabilize and recover. Second, cost control. How is their SG&A expense ratio trending? Third, policy. We need to stay on top of any updates on those EU tariffs. And finally, the sales mix. The performance of their high-value tank and Wakey brands will be a huge indicator of whether their premium strategy is actually working. So this leaves us with the final defining question. Great Wall Motor is making a massive, calculated bet to transform itself into a global, electrified powerhouse. The central tension is this. Will these incredibly heavy investments successfully build a competitive fortress for the future? Or will the immense pressure on profits, combined with these severe geopolitical headwinds, simply burn out the strategy before that foundation is ever set?